All right. Good fucking morning, everybody. So the title of this presentation is Full Send. As many of you know, I spend a large part of the year skiing, mostly in Japan, in Hokkaido, in the backcountry. And if you are a skier or a snowboarder and you spent time skiing where there's no lifts, you understand that you probably should have a little bit more caution when approaching, jumps and cliffs and different things, because, if you fuck your shit up, you could actually just freeze to death out there. And so going full send on anything is quite risky. And you never exactly know what the landing is like or what the snowpack is going to be like once you drop a cliff or something like that. But you do it anyways because it's fucking fun. That's why I tell this presentation full send. It's time to go long everything. It's time to back the fucking truck up, buy Bitcoin, buy shitcoins at some point in the near future. And obviously, the future isn't known. We don't know exactly what's going to happen. But I think after this 18 minutes, I should give some of you a little bit more confidence that what we're seeing today in terms of a market setup, we've seen before as short ago as 2022 in September in the third quarter. Ask yourself this question. Back in September, October, November of 2022, were you buying Bitcoin? Or were you afraid of something that prevented you from hitting that buy button? Prevented you from loading up on risk assets in your portfolio so you could outperform the debasement of fiat currency. So 2002 was a very scary time. Central bankers, the people that have pumped our bags since 2008, were actually restricting monetary conditions. They were raising rates. Here's a chart from Ned Davis Research, and it shows the number of central banks that were hiking versus reducing interest rates. And in the third quarter of 2022, almost 100% of central banks that they monitor were actually in a hiking cycle, which obviously weighed negatively on risk assets globally. 2022 was scary for the bond market. I don't know if you remember, back in 2022, U.S. Treasury bonds had some of their worst performance since the War of 1812, 200 years. Volatility was spiking in the third quarter of 2022 as yields were approaching 5% on the 30-year bond, above 4.5% on the 10-year bond, and people just didn't want to own fixed income in any way, shape, or form. And 2022 was very scary for our industry because Sam Bankman-Fried stole $10 billion of people's money. If you want to think about the poster child of good crypto, it was Sam. He donated $100 million to the Biden campaign. His parents were very politically connected. Here he is on stage with Bill Clinton and Tony Blair at a conference in the Bahamas, and yet he's a complete and utter fraud. So if he is stealing the money, what about the rest of us fucking degens? What do people think about us? With all that was going on in 2022, if you were focused on all the negative things, you missed what was really going on behind the scenes. And that we handed the baton off from the Fed to the Treasury, at least in America, and the rest of the central banks followed suit. So here's a little ChatGPT-inspired blister pack of one of my favorite government officials, Bad Girl Yellen. She's got a pair of Louboutin stilettos that she's going to bash Jerome Powell's head with, and an infinite money printer. Now, what her and her department did in 2022 to address this problem of dysfunction in the Treasury market and falling stock market was to pump $2.5 trillion via draining the reverse repo program, which is where a lot of cash is parked after stimulus checks in 2020 and 2021, and this money was sitting there doing nothing. And she thought, okay, let me tinker with how I issue bonds. I'm going to issue more short-term debt, issue less long-term debt, give an incentive for those who have money in the reverse repo program to buy my debt and thus re-leverage it in the financial system. And so she did this starting in third quarter of 2022. If you look at the chart, and I'll show you in a second, the high point of $2.5 trillion for the reverse repo program was about September 30th. By early of this year, it was down to about $200 billion. And this was a story of the rocking and roaring 2022 to 2025 markets where Bitcoin and a lot of other things did very, very well. So here's an index chart. 100 is where we started. December 1st, 2022. Bitcoin 6x, great. Gold and stocks doubled almost. And the white line there is the reverse repo balances, and as you can see, declined about 80%. So Janet Yellen and her activist Treasury issuance policy was directly responsible for the bull market that started with the collapse of FTX when Bitcoin went from 15,000 to over 100,000 earlier this year. So what did we learn that we can apply to the current situation. So there's an index called the MOVE Index. It measures bond market volatility. If there's anything that you guys take away from this presentation, is this is the thing that you need to watch to understand when financial authorities will step in and print more money. So when this index gets at about 140, you have immediate response from policymakers. Back in 2022, this index hit about 140. Janet Yellen swung into action and essentially printed $2.5 trillion. Now, quantitative easing is a bad word. Everybody in this room knows it means money printing. Everybody outside this room who isn't a crypto investor knows it means money printing. And we know that money printing means inflation. And if you're a democratically elected politician, inflation is death. It means you do not get reelected. And so you can't have the Federal Reserve or the Treasury doing something that everybody knows is inflationary. We know what quantitative easing means. Buy bonds, stock market rips, inflation goes up, wealth inequality expands, people get upset, and they vote in another party. Can't do that. We have to do something else, something a bit more tricky. The people aren't going to understand that it's money printing. So that's why everything you see out of the Treasury technically isn't quantitative easing. It's something else, but the end result is there's more dollars, more yen, more euros, more yuan in the system, and Bitcoin pumps. Why aren't you buying Bitcoin right fucking now? On your phones. We got internet here. Buy some fucking Bitcoin. You guys are all rich. What are you scared of? We're scared of the Trump man. He's got a fucking cardboard. He went out 2025. He said, I've got these fucking tariffs, and I'm going to beat you over the head with them. And they were so big. His tariffs were so big. They were bigger than anyone would thought they would be, and completely crashed the financial markets. And now people have a lot of uncertainty. They don't want to invest. They don't want to trade. They don't know what to do. It's scary because we have Jerome Powell. And here's my little blister pack of Powell. He's got a little Paul Volcker ghost. He's going to keep monetary conditions tight because he really hates Trump and he wants to stick it to him. And so Powell is not going to provide the monetary easing that this transition requires from a hegemonic state to a multipolar situation. So Powell's not on our side. He's not printing any more money. He says, fuck Trump. I'm going to sit over here and, be all Paul Volcker-like. April 2025 is scary because tech stocks got the stick. There's this narrative going on right now that Bitcoin and crypto is just a high beta version of the NASDAQ. So the NASDAQ is down, at least when I took this chart to early April, something like 20%, entering a corrective situation. People's risk appetite is diminished because the best performing TradFi asset, US tech stocks, are getting absolutely crushed. April 2025 was scary because the bond market volatility spiked once more. So after April 2nd, Liberation Day, when the tariffs were announced, by the end of that week, the MOVE Index hit an intraday high of 172. It has hit that level almost 3 times past history during the global financial crisis and one other time. So this was a oh fuck moment. Shit is about to break. And what do we say about what happens when this index hits 140? We get an immediate policy response. I put the big boy. He's got a floppy noodle, and he's gonna, beat Jerome Powell over the head with his, method of quantitative easing. And so Bessent went on television on April, I think 10th or 11th, to Bloomberg, and the journalist asked him, the Fed is keeping money tight. The financial markets, there's issues. Trump called it, I think, queasy or something. What are you, as a Treasury Secretary, going to do to help the markets? And he responded, I have this thing called buybacks. And subsequently to that date, April 9th, that weekend, we have been up about 30% since that date. But again, what have we reaffirmed here? We have to learn. 140 on the MOVE Index, immediate policy response. The second it hit 140, Jamie Dimon, CEO of JP Morgan, gets on television at CNBC, says Trump's a fucking retard in his own very politically correct way. Trump immediately pivots. Tariffs are paused for 90 days for everyone except China. Bessent gets on the speaking tour talking about how he's going to do buybacks and how that's going to restore the integrity of the U.S. Treasury market. And Susan Collins, the Boston Fed governor, went on and gave an interview with Financial Times stating that the Federal Reserve stood ready to do whatever it took to make sure that the financial markets were well functioning. Again, this is all subsequent to 140 on the MOVE Index. It's the only thing you guys take away from this presentation is that level. And so if you don't understand buybacks, there's a very simple explanation. Essentially, it's a budget-neutral, supply-neutral way for the U.S. Treasury to influence how much leverage is given to marginal buyers of Treasury debt. And so what they do is they issue a new bond, They take those proceeds and they buy an older bond. Now, this is important because there's a large section of Treasury traders, these hedge fund managers, and what they do is they buy a bond in the cash market, they sell a futures contract, and they wait for that very narrow spread to collapse. And if you apply a lot of leverage to that, you can make good money. The gating factor in how much they can do, how much they can show up at the auction and buy, is how much leverage the banking system can give them. And on the banking side, a new bond that's liquid has a less capital charge than an old bond that's illiquid. So if Besson is able to take these old illiquid bonds off of these RVs trading books, then these guys can relever, go to the bank, get more leverage, create more money, show up at the auction, and buy debt at whatever price Besson wants to sell it at. So these RV hedge funds are the marginal buyer of Treasury debt, and Besson is doing all he can to make sure that they can show up and participate and make sure the U.S. government is funded at a very affordable level. And this is how liquidity is pumped into the market. So yes, technically speaking, a buyback is not quantitative easing. It is not money printing. It does not really influence the amount of dollars in the system, but the second order effects are positive for dollar liquidity and obviously for our bags. This all predicated on, will there be more U.S. borrowing at the federal level? There's a narrative right now that Elon and Doge are going to cut a bunch of stuff and rectify this out-of-control spending from the U.S. government. Here's a chart from the Peterson Institute. So the U.S. fiscal year starts in October. So if we look at October to March, this is the latest data we have data from, versus October to March of 2024, we are already tracking 22% higher in terms of a fiscal federal deficit. Biden spent a fuck ton of money. He spent $7.1 trillion. Trump is starting to spend even more than Biden, even regardless of what he's actually saying. The U.S. taxpayer is broke. A large part of driver of tax returns in the U.S. are capital gains, meaning the stock market. So I just showed you a chart of the NASDAQ down 20%. People aren't making money in the stock market. They're not paying taxes. So we don't have their official data out yet, but there's an expectation that the April 15th personal tax deadline, the amount of money that the Treasury Department received is less than usual. This particular analyst says up to $500 billion. We'll find out in the next couple of months what that number actually is. And the private sector is broke as well. We printed all this money. We gave people stimulus checks in the United States, and they spent it all. And so they can't park it in the reverse repo. They can't park it in money market funds. They can't show up at Treasury auctions to buy this debt, which means that Besson is entirely dependent on relative value hedge funds to come to auctions and fund all the debt that he was issuing. So at the end of the day, who is the sucker who's going to buy all this stuff? So here's a little rundown of exactly how dollar liquidity is created through buybacks. So essentially, U.S. deficit rises because our tax receipts fall. The U.S. deficit outlays, how much they're spending, cannot be curtailed either legally or structurally, right? Elon's going around saying he's going to cut all this stuff. Then you have judges saying you can't cut this, you can't cut that. So we don't know where everything washes out in terms of actually the impact of this, government efficiency drive. And then if you think about the United States, the large part of spending is Social Security, Medicare, healthcare for old and the sick, and the defense budget. And these are the third rail of American politics. You cannot cut these things or you will not be reelected. I don't care if you're a Democrat, Republican, or independent. Nobody can touch these things. And so because the deficit is rising, and I showed you a chart rising 22% already year on year, they have to fund a larger deficit. Now, if you fund a larger deficit out of savings, there's no net impact to the amount of dollars issued in the world. They're broke. They don't have any money. They can't buy any bonds. Okay, well, next person, the foreign sovereigns. So China, Japan, Germany, can they buy more bonds? In 2022, the Biden administration decided to steal the largest commodity producers' treasuries, Russia. So if I'm a sovereign manager, do I really want to own a lot of treasuries and possibly get them confiscated if I fall afoul of the whims of whoever's in charge of the United States? No, and that's why we've seen a secular rise in gold and the amount of purchases by sovereign governments of gold since 2022, because they're just afraid of what happens if whatever they do or they say is not really liked in Washington, D.C. The Chinas, the Japans, the Germanys, Saudi Arabia, they're not showing up at the auction and buying as much debt anymore. And especially after April 2nd, when Trump has basically said, hey, the U.S. is running a current account deficit, which means a capital account surplus. We want that to go to zero. So if I don't have the dollars as an exporter to buy bonds, I can't buy them mathematically. Therefore, I cannot buy as much. So foreign sovereigns can't fund the increased deficit spending. The Fed won't fund it. I showed you, Powell and the ghost of Volcker. He's not stepping up to the plate and expanding his balance sheet to buy bonds. Maybe that changes at the end of the year. There's some rumors about that, but at the current state, he's not doing it. The banking system can't fund it. Their balance sheets are full. Basel III, all these regulations put in after the global financial crisis in 2008 have restrained the ability for the U.S. commercial banks to continue gorging on treasuries. And in actual fact, they got kind of fucked in 2023 when the bond market collapsed and we had 3 banks go bust in the span of 2 weeks. So the willingness of the banking system to show up at auction and buy really highly priced treasury debt is not there. So the only person or entities left are these relative value hedge funds that I talked about. And what do they need? They need leverage. They need leverage from the banking system. The banking system has too many old bonds. Best is going to take those old bonds off their balance sheet, is give them new bonds, give them more leverage, and they're going to show up at auction and buy more debt. And this is how dollar liquidity is created in the system. And so the question is, did you buy Bitcoin on April 9th when we had this policy pivot? 140 on the MOVE index. We had every manner of person within the U.S. administration changing their tune to support the markets. And Bitcoin is up 30% around since then. But don't worry, we're going to $1 million by 2028 because we're going to print more money in Trump's 2.0 than Biden did in his term. Why? For all the reasons that I just mentioned, we're already tracking at 22% higher. What happens if this China-U.S. sort of divorce goes badly and both sides stick to their own guns and don't want to compromise? Well, is Trump and the Republicans going to not try to win a 2026 midterm election? Of course not. They're going to do what they need to do to stimulate the economy, to create the impression of growth and strength so that they get reelected just like any other politician. And so because of this secular change in the relationship between the two largest economic and military powers is going to be funded with printed money, Bitcoin is going to go much higher than it did from 2022 to 2025. And that, ladies and gentlemen, is a road to $1 million Bitcoin. Thank you.